Welcome to The Explainer. Today, we're going to explore how losing money on an investment could actually be, well, a pretty brilliant financial move. We usually see those red numbers in our brokerage accounts as absolute failures, right? But today, we're going to reframe that entirely. So, what if losing money on a stock could actually save you money on your taxes? I know, it sounds a little bit like a magic trick, but this is actually a highly structured, fully legal strategy that savvy investors use all the time, especially when they're looking at their portfolio's annual performance right at the end of the year. It's all about turning those investment losses into massive tax-saving victories.
Here's our roadmap for today. We'll start with what tax loss harvesting actually is, walk through the math behind the savings, look at some common tax mistakes, dissect the wash sale trap, and then wrap up with the bottom line.
All right, Section 1. What exactly is tax loss harvesting? Tax loss harvesting, some people call it tax loss selling, is basically the timely selling of securities at a loss to offset the amount of capital gains tax you owe from your profitable assets. Think of it kind of like returning a pair of expensive shoes that didn't quite fit to help pay for that jacket you really love. By strategically selling an asset that's dropped in value, you can claim a credit against the profits you've realized elsewhere. This directly reduces your overall tax liability for the year. It's a real game changer. Moving on to Section 2, let's look at the actual math behind these savings. To put this into perspective, let's take a high earner with a 37% marginal tax rate. Say they have a massive $350,000 in realized gains. They sold Mutual Fund E for a $200,000 long-term gain, which gets taxed at 20%. They also sold Mutual Fund F for a $150,000 short-term gain, which gets hit with that much higher 37% marginal rate. I mean, that is a heavy, heavy tax burden. But sitting right there in their portfolio, completely unsold, are $230,000 in unrealized losses, basically trapped in mutual funds B and C. Now here's where the magic really happens. Without harvesting, they're paying 20% on that $200,000 and 37% on the $150,000. That equals a super painful $95,500 tax bill. Ouch. But if they harvest the losses from funds B and C, they can actually offset those gains category by category. The math completely shifts, and it drops their tax bill down to just $32,500. They literally wipe out over $63,000 in taxes simply by executing the strategy. Pretty wild, right? And it gets better. A crucial point here is that even if your capital losses actually exceed your gains for the entire year, you can still deduct up to $3,000 from your total annual income, or $1,500 if you're married filing separately, and then just carry the rest forward. The IRS rules explicitly allow you to take those additional net losses that exceed that $3,000 mark and just carry them right over into the following tax years. So it's this incredibly flexible benefit that just keeps working for you over time. All right, let's jump to Section 3, common tax mistakes. We definitely want to avoid these. You see, you can't just mix and match your losses however you please. The IRS basically treats this like a very strict matching game. Step 1, short-term losses first offset short-term gains. Step 2, long-term losses first offset long-term gains. A super common mistake investors make is crossing these streams way too early. You absolutely must offset the exact same type of gain first. Only after you've completely matched the same types can the net losses of either type then be used against the other kind. Okay, moving right along to Section 4, let's talk about the wash sale trap. The wash sale rule is basically the ultimate trap for the unwary investor. If you sell a security at a loss and then turn around and buy a substantially identical security within 30 days, the IRS is going to completely disqualify your tax offset. You can't just sell a stock for tax purposes on day 1 and simply buy it back on day 15 because, you missed it or think it's going to bounce back. If you do that, bam, it's a wash sale. Regulators take this incredibly seriously. To stay in the clear, you absolutely have to wait until day 31 to safely purchase that exact same security again. But obviously, selling an asset kind of disrupts your carefully constructed portfolio balance, right? You still want your expected risk and return levels to stay stable. Well, here is a really clever workaround. You can maintain your portfolio's balance without violating the rule by simply purchasing a different ETF that tracks the same or at least a very similar index. For example, if you sell one S&P 500 index ETF at a loss, the mistake would be buying that exact same ETF back within 30 days. The solution? Buying a different provider's S&P 500 ETF. Because it's managed slightly differently, it avoids being classified as a substantially identical security. This keeps you perfectly within the bounds of the law, while the whole time keeping your portfolio perfectly balanced.
Which brings us to our final stop, Section 5, the bottom line.
Let's do a quick recap. You can strategically sell losing securities to offset your profitable capital gains. You can even deduct up to $3,000 annually against your ordinary income if your losses happen to exceed your gains. Just remember to beware that 30-day wash sale rule. You can utilize that clever ETF swapping trick we talked about to keep your portfolio balanced. And hey, because marginal rates and these strict matching rules get really complex really quickly, bringing in a professional advisor to maximize your unique tax breaks is honestly highly recommended. Before we wrap up this explainer, I want to leave you with this final thought. Take a close look at your own assets. Ask yourself, are you leaving money on the table? Like, are there hidden losses in your own portfolio right now, just waiting to be harvested so you can erase some tax liabilities? Remember, a red number doesn't have to mean a complete loss. In fact, it just might be your next great tax-saving asset. Thanks so much for joining me on this deep dive.